All right, the one category that we've not spoken about yet on today's program is fixed income, and let's amend that, let's correct that. Joining me now is Devang Shah, who's the head of fixed income at Axis Mutual Fund. Devang, thanks so much for taking the time. Pleasure speaking with you on Your Money Matters. I've spoken to you so many times over the course of the last several years about fixed income. It's something that is very close to my heart, but investors have perhaps a little bit turned away from the category because of the change in the tax laws. Interestingly though, I hear a lot of buzz about one specific category, and among others, but this is the income plus arbitrage fund of fund category. And a lot of people have heard about it, but a lot of people haven't. Why do you think that this is getting so much traction?
Yeah. So thanks, Alex, for having us. And as you rightly highlighted, I think fixed income is a good topic which it's close to both of us. See, over the years, as you rightly highlighted, and if you look at 2010 or before, the overall debt pie in the overall fixed AUMs of mutual funds was significantly higher. And post the tax efficiency and over the years, I think its share has been continuously falling. But it is not completely right that flows have stopped in the debt mutual funds. In fact, if you look at the last 12-18 months, thanks to the macro cycle and all the, you spoke about one category, which is income plus arbitrage. I think the macro reasons, as well as the introduction of this new category, we've actually got a lot of flows. If you look across on a base in the last 2 years, from a base of 14 lakh crores on fixed income AUM, today it's moved closer to around 19 to 20 lakh odd crores. So it's a good growth over the last 2.5 years. Yes, a part of it is coming into the traditional money market solutions, large part of it. A lot of movement and growth of AUM has happened in corporate bond funds. But coming specifically to the new category, I think the new category is gaining a lot of traction from in the last 12 months. So we got clarification about this category into the tax bill in July 24, and post that with consultation with SEBI, the regulator opened up this category. It is income plus arbitrage. If I simplify this category, what does it mean? It's an open-ended fund of fund, whereby 65% of the assets, up to 65% of the assets are held in debt, and 35 to 40% of the assets are held in arbitrage funds. The combination of the two, SEBI has classified this category where you own less than 65% debt and 35 to 40% non-debt. It is called a specified mutual fund category. And if you hold your investments for more than 2 years, you're actually taxed at the rate of 12.5%. So in a simple terms, this actually takes you back to the pre-2023 tax efficiency, which was there on debt mutual funds, by just tweaking our allocation partially by allocating to arbitrage funds. So this category has got a lot of traction over the last 12 months, and we have seen more than 25,000 crores of AUM coming in this category. There's participation all across, from institutions to ultra HNIs to retail individuals. So I think this fund of fund category is buzzing around and making a lot of sense for investors who are looking at stable, tax efficient solution, less volatile, debt-like returns over a medium term.
Got it. Okay, the reason I like to talk to you often is to get a sense of where we are in the debt cycle, right? And basically the interest rate cycle, because that provides you with opportunities on the fixed income side. A lot of people look at fixed income investments and think fixed deposits, but you can actually make significant capital gains if you time your investments appropriately. And it's not like timing the market in the equity market. Directionally, you can understand where things are headed. So where are things headed? We are at, 5.5% on the repo rate side. Are we expecting a 5% repo rate in the next, say, 2 to 4 months? Considering that inflation is so benign, inflation is so low, there is ample room to bolster growth. Do you think that that's likely to happen? And also comment, Devang, on the fact that on the 10-year yield, and I'm talking about the India bond yield, you've actually had a move higher because of the foreign flows probably over the course of the last few months. Do you see an opportunity there at the longer end of the spectrum to say that you can make an investment in these long bond funds to get capital gains in the future?
So, Alex, you are right completely. I think fixed income funds are the only way out whereby investors, if they want to ride the interest rate cycle and probably take some tactical opportunities, get some capital gains on account of interest rate cuts, I think fixed income vehicles are a very, very good solution for such investors. Now, coming to the specific question on where are we headed on macros, I think June policy onwards, the market got actually very worried. There were two or three reasons specifically. I think one, the stance change from RBI came a bit abrupt because generally a central bank cuts rates and stance change doesn't happen together. So 50 basis rate cut was very, very well accepted, but with the stance change, I think it spooked the market. Markets thought that probably this is the end of the cycle, and hence we saw some uptick in bond yields. But the major concern started coming in mid of August with the announcement of the GST cut, where people started feeling that if the policymakers have started using fiscal tools, the room for monetary policy easing will be very, very limited. And there can be case for additional borrowing, which led to the rise in yields. So as you rightly highlighted, from the period of June till August end, we actually saw, despite the rate cut of 50 odd basis, we saw yields hardening, yields moving up by around 25 to 30 odd basis. But I think coming into this policy, again, central banker has made it very, very clear. Thanks to the GST cut, the inflation outlook continues to remain benign. So whatever worries they had on account of tariffs, some volatility in oil price, and the base effects working against next year, I think the GST cut leads to a fall in inflation. The projections going closer to 4.5. The second big positive which came across from this communication in the October policy as per us is the growth revisions which they are having. The growth revisions have obviously it's been tilted up for the near term because the Q1 growth number was very strong, but the H2 growth numbers as well as the growth projections for the next year can be lower because of the tariff rate which has been now continuing at the rate of 50 odd percent. So in the context where inflation continues to remain benign, growth outlook remains patchy, I think this opens up space for RBI to cut rates. We believe so that the policy rate cut in December is a very, very high probability, and they can do a 25 basis cut to smoothen up the markets and support the economies, more specifically the growth cycle. Will the 25 translate into 50 odd basis of rate cuts over two policies? I think depends on how long the tariff rate continues in India at 50%. If it continues for long, I think there is possibility that the growth numbers can be weaker, and it opens up the rate cut possibility taking it to 50 basis and moving the repo rate closer to 5%. The other two big positives which can come, Alex, as per me, in the next calendar year can be, you spoke about FPI outflows. I think there's a possibility that Bloomberg can look at adding us in the global aggregator index, which can get us some 20-25 billion of flows into India, which will lead to some tactical rally in long bonds. So I would say yes, we can hold on in anticipation of rate cuts and this possibility inclusion of our bonds into Bloomberg indices. We believe there is scope for 10, 15 to 20 basis of rally or yields getting lower in the next 3 to 4 months.
Got it. So the last point, Devang, is that while we speak about the potential for fixed income, and I think there certainly is a place for it in your portfolio, a lot of people are choosing to take that exposure through your hybrid funds, whether it's your balanced advantage fund or your multi-asset fund, etc., right? So would you say that those strategies are also playing out in those hybrid schemes currently for your mutual fund?
100%. So I think today, if I look across at all my hybrid funds, whatever is the macro view on the outlook, which is more like you are expecting rate cuts, you are expecting some bit of rally in long bonds. Accordingly, we have moved our duration across in our hybrid funds. So if you look across, last year we were very bullish on rates. All our hybrid funds were running a duration which is closer to a dynamic bond fund, which is 7 to 8 years. Now, where we see that we are at the fag end of the rate cycle and there's some tactical rallies of opportunities available, the duration has reduced, but is moved towards a 3 to 5 year segment. Once the cycle is over, and we believe so, the next cycle will be a carry accrual based cycle where you just get a good carry, the duration will be significantly lower further and move to the 2 to 3 year segment. So definitely, as per our macro view, even the in the hybrid funds, the debt portion keeps on maneuvering the duration and the choice of asset class.
Fantastic. Okay. So, Devang, thanks so much for joining in, as always, and pleasure speaking with you. I certainly enjoy these conversations about fixed income, and I'm hoping that my viewers increasingly do as well. Thanks so much for taking the time.
Thank you, Alex.
All right. Well, that brings us to the end of this edition of Your Money Matters. Thanks so much for tuning in, and do stay tuned. Lots more coming up on NDTV Profit.